You are listening to Keystone's Stock Talk Show, episode 255. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be back. I will start this week's episode by detailing how rate increases change the growth stock equation and how we use this theme this past fall to recommend two unknown Canadian growth stocks to our clients, producing two stocks that have jumped over 100% in less than 9 months. We will also tease a recent recommendation that holds $85 million in cash, or 28% of its market cap, with no debt. It just saw earnings recently increase 296% and can be bought today at roughly 8.75 times earnings cash out. Our Your Stock Our Take segment, Aaron will start with a viewer question on Autodesk Inc., symbol ADSK on the NASDAQ, a leading global software company that primarily through its AutoCAD solution provides 3D design, engineering, and entertainment technology solutions. The share price has dropped since early April of this year after it initiated an internal investigation regarding some of its reported financial numbers. This week, Autodesk announced that it will not restate or adjust numbers, and also recently announced its preliminary guidance and outlook. Aaron reviews the recent news. Brennan will revisit a past Your Stock Our Take on CloudMD Software and Services Inc., symbol DOC or DOC on the TSX Venture, which provides mental, physical, and occupational health services, healthcare and navigation, absence management, and healthcare productivity tools in both Canada and the US. We have answered questions on CloudMD in the past when the stock traded at the 60-cent range and $1.80 range. With the company now trading at 3.5 cents, we're pleased to state that we have not found any value in the business in the past and have taken a pass on the stock. Brennan let you know where this cautionary tale is today. To close, Brett will answer a viewer question on Reddit, symbol RDDT, which unsurprisingly owns and operates the website Reddit, an online network of unique communities that allows users to dive into experiences built around their interests, hobbies, and passions. The company IPO'd in March of this year at $34 a share, but quickly jumped after the opening. The shares are now up at about $55.30, up 9% from the close of the first day of trading, and Reddit has now reported its first quarter as a public company. Brett takes a look at the company's financial picture following the release. Now let's get to the show. We welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Very well, thank you. Yourself?
I'm good.
You're very happy today?
Oh, couldn't be
very
happier.
happy
Made it
for
to
the Oilers.
Stanley Cup, so
it's so great to see the Oilers going to the Stanley Cup Finals, or maybe not.
Let's go Oilers.
We're happy.
Can I show you guys?
And all of our many,
no, you can't.
And all of our many clients who are
just delete this part.
So.
I just want to show you guys something pretty quick. I thought this was pretty cool. I don't think that I've shown this on the podcast before, but my uncle actually used to be the organ player back in, I guess, 87 and 88 when Gretzky was still playing, and they actually made I guess that was the last time Gretzky won the cup with the Oilers. So just to combat Ryan for saying that I'm an absolute bandwagon jumper, I needed to show that I've got some family.
Those aren't your parking passes.
Sure
of course they aren't.
Your uncle. I'm not sure if that proves
Of course
anything.
they aren't. But
plus,
it does
we had season tickets during that period in the 80s and used to have the Oilers come in and we'd watch them drub the living crap out of the Canucks. with Gretzky, Messier, and the whole crew. Yeah. And it was a really, really fun time. So you'll pardon me if I do not cheer on the Oilers as they go to the final. I'm going to put this in context. The fair weather fan that we're seeing here, this Oilers fan, Brennan, is shocked that I'm not over the moon. And now cheering on his beloved Oilers as they're going to the finals, the only Canadian team remaining. Like somehow this should oblige me to switch allegiance, a practice that he's only too familiar with, and say, let's go Oilers all day. Well, I'm going to give you an example, a quick example of this. It's universally known that the Boston Red Sox fans hate the Yankees, correct? You guys know this? Like, correct. We know this, right? So here's a scenario. The Yankees, as they have in the past, beat the Red Sox in a playoff series. Then they go on to face the Toronto Blue Jays. So do you think for one moment Red Sox fans would even consider cheering for the Yankees just because they were the only U.S. team in that series? They would literally sooner sell their firstborn than cheer for the hated Yankees in a series against anyone. So does that give you an idea of why
I will make a point, though, to
don't
that's
cheer on a hated rival. This is not going to be a good point. I'm going to tell you that right now.
Canadian baseball team recently won the World Series.
There's only one Canadian baseball team.
Exactly. But how many times recently has the Canadian team won this?
They won it back in back-to-back 93, 94, I believe.
It's been a while.
Mm-hmm. How many times have the Canucks won the Stanley Cup? 0 in 50 plus years. How many times have the Oilers won the Cup? They won it literally 5 out of 6 years. It's not happening. I'm not cheering for the steaming Oilers.
Cheering.
Apologizing.
I already bought you an
apologizing
Oilers
to our
it's being delivered.
Oiler Flyers. I'm apologizing in advance to our Oiler client fans, which I exchange emails with all the time. I'm happy for them. I'm just not going to be cheering on the Oilers.
Just not happy for you or Brandon.
That's fair.
Yeah. I'm happy for them. And I hope they have a great time, and I hope they can cheer a lot. I just will not be cheering, and I'll be, tearing apart part of my heart if they actually win this Cup.
What did you say to me earlier today? Didn't you say the Panthers are your team? It was fun.
Oh, yes. I've now newly adopted favorite team, the Panthers.
Yeah.
I hope it's just some really good hockey. That would be great to see. For sure.
Me too.
But that's my rant. Nobody wants to hear it. They want to hear about stocks, right?
Yeah. Well, let's go from Oilers to AI. What do you say? There was a poll, I think.
Yeah, there's a poll. Brett has the poll.
Yeah.
You're
so
gonna pull this up.
Nice.
Really nice transition.
Great transition. Oilers are being replaced with AI next year. There we go. So the question is, are you bullish on AI-driven stocks at the current prices? So we had 16% at yes, 37% at neutral. They're at fair value. And 47% are bearish on AI stocks at this time.
Yeah, I'd say like the general universe. The problem is there's a bunch of companies in there that are just either changed their name that put AI in it in the last year, or they have no revenues, no earnings. I mean, we certainly believe, I think, in the theme long term. I don't want to speak for everybody here. And there's 2 companies that we participate in that are leaders in the segment. But as far as like, if you want to encompass every stock that is now choosing or selecting AI as a primary part of their business when it likely isn't, I would be cautious on companies that have either just revenues or no revenues and just, have a plan to be involved with AI at some point. I mean, it's just like anything we'd be cautious on.
Really, like the more truth there is in the underlying theme, sometimes the more dangerous it is as an investment class, because what happens is all of that excitement attracts the wrong types of companies, right? Like it's an opportunity for some people to engage in promotion to basically piggyback on what is a legitimate theme, a legitimate technology, and raise money essentially from investors without any intent, or at least without there being a good probability that they're going to build a sustainable business. And I mean, if you go back to 1999, was the internet, a major technological shift in society? Absolutely it was, but it doesn't mean that you go and buy everything with .com at the end of its name. And anybody who did certainly got experience in pain.
I would even
and
go.
there's
I'd
sorry,
go a
go,
bit
go.
further than that. Even things that are tangential, which do benefit from AI. So I looked at Super Microcomputers (SMCI) back in March. It was trading at $10.85 a share, and at that time I was saying it was overpriced, and we've already seen it come down to $7.70 or so a share. So that's a 25% drop just in that time. While you've seen still really what everything's been looking towards is that NVIDIA, but you've already started to see some of these other relevant or nearby companies already start to fall off. They're not staying up with that NVIDIA hype train. And I think that's really the first ones you're starting to see is get weaker. Yes, they do benefit from the AI trend. They benefit from servers in a SMCI scenario or case, but they just can't have the margins. They don't have that 80 plus 90% margin, which you're seeing with NVIDIA. And I think that's the issue which many people are seeing or having is they're not seeing the valuations for what they are. Right now you're requiring these massive growth with some companies like SMCI. It's effectively impossible for them to improve their margins like you have in NVIDIA, or you're seeing that across really any of these AI-esque companies. They just can't get the margins. Their financials cannot support it. Their business model can't support it. The underlying product does not support their valuation. Even if you're looking 3, 4, 5, even a decade ahead, some of them, the valuations are just getting so absurd at times. And I think you can guess which one I would vote for. I didn't actually vote in it. I am overall bearish for the AI. Just due to the valuations, I think can eventually be a great product. I use AI. I use the Adobe suite effectively every day and use AI in that. I use ChatGPT at times as well. I use the products, but I don't think the valuations support it.
Yeah, and there's companies, really good companies that also we're not sure. It's a threat and an opportunity. I mean, Autodesk today, Aaron's going to be talking about. I mean, there's a threat and an opportunity for the business. So how that plays out, I'm not certain. But we certainly don't. There's some companies that, are just stating that they will now be involved in this area. And like Brad was saying, the valuations are ridiculous. You just can't pay anything just because it's just like you can't pay anything just because somebody puts .com behind their name. But that would be, you couldn't pay anything because cannabis was involved in their name as well.
Or telemedicine or
3D printing. Like we saw these in, smaller degrees in some sectors, larger degree in some or segments. But, the advice would be the same in any area. If the company is not making any money, if there's not growth, or you're paying too much for the earnings, that it has to hit massive blue sky returns to actually justify the price, then those aren't good investments. That's asymmetrical return potential on the downside, essentially, right? Like you're more likely to have a poor return than a negative return. It's not good, or a poor return than a positive return. Those are not good bets over the long term, regardless of what sector we're talking about, what hot theme we're talking about. All right. Do we want to move on? I'm going to look at a theme that we looked at in the fall 2023 time period, and it's playing out in real time here. We saw rate increases change the growth stock equation this past fall. After completing research for our cash-rich Canadian growth stock report, one intriguing theme developed. The research for this report includes literally manually screening through 3,500 plus Canadian stocks for profitability, strong net cash, which would just be more cash than debt, their balance sheets, and looking for growth. After looking at thousands of balance sheets and cash flow statements, it was clear that there was a significant post-pandemic rate increases. Those significant rate increases had changed the growth stock equation. This theme created a tremendous opportunity. Growth stock companies with net cash were positioned with a significant advantage. So I'll detail this for you right now. 2 to 3 years ago, a decent cash flowing growth stock could get funded or get debt for between 3 to 5% or lower in some cases. Today, if they can get it, they are paying 8.5 to 12+% in some cases. Their cost of growth capital is 3 to 5 times higher. So our thesis here was that strong balance sheets were critical. Growing net cash businesses were positioned well and should be rewarded over the next year. And Similar over-leveraged businesses were in for tougher times. Now, I'm going to give a simple real-world example here. Let me give you this specific real-world example from our research, and it will outline and show you the success of this strategy over the past 9 months, which is a very short period of time. We'd expect it to play out actually over a 2 to 3 year period, but I'll give you an example here. The following is based on 2 real companies that we considered for recommendation in late summer, early fall of 2023, both profitable specialty pharma businesses. They were in licensing, acquiring, and selling unique drug treatments primarily within the Canadian market. I will simplify the 2 situations here for my example, but financially, the major difference was found in their balance sheets. Company A, 50 million in net cash. Company B, 50 million in net debt. Now, when that debt could be had for approximately 3%, we still preferred the company A, or the net cash company, over company B, the net debt company, paying only 1.5 million in interest. It was not truly affecting the cash flow or the business's ability to execute on its growth strategy. Today, with the debt costing 10%, company B is paying 5 million in interest. That figure has become material, and it's eating significant cash flow. On the flip side, company A, the 50 million in net cash businesses, for example, has no debt service payments, and as a bonus is now being paid, say, 5% or 2.5 million a year on that cash, where it was receiving effectively zero just 24 months ago. The net benefit could be, in this example, the cash risk versus the debt-heavy business is 7.5 million. 5 million, it is not paying for the costly debt, and 2.5 million in bonus interest. So company A benefits with a 7.5 million swing, largely by positioning itself with a strong balance sheet. But the benefits of a strong balance sheet don't just end at better cash flow. Growth businesses, by definition, these businesses are looking to grow. Highly leveraged businesses operating with one hand tied behind their back right now in a higher interest rate environment. As a result, they're less able to execute. Again, those benefits, the strong balance sheet in this environment, they don't just extend to better cash flow. All these companies are looking to grow. Like we said, highly leveraged businesses are operating, like I said, with one hand tied behind their back. So again, we talked about that. Now, net cash positions that have allocated or really have an advantage in this environment, and what they're looking at is they have great avenues. Sorry, I'm going to pull that back. They have great avenues to allocate that capital. They can create great shareholder value. Those kind of arrows in the quiver are share buybacks, dividend investing, or to invest in their own business or buying back other businesses to grow. Now, your question should now become, does all this balance sheet business make a lick of difference in terms of share price performance? In the investing world, it all comes down to returns, and the difference in performance between company A and company B could not be more pronounced over the past year. And they could really be just the tip of the iceberg for these type of companies. Now, this is my real world example. I'm going to get back to it. There were 2 specialty pharma businesses. Our research team sat down with management and reviewed both these businesses in the fall. The first company, company A, the one we recommended was Cipher. It is a business that sells the number 1 doctor prescribed acne treatment in Canada. Cipher had a profitable core business, 50 million in net cash approximately. We recommended it at 389 in late August. The other company was Medexus Pharma, symbol MDP. It was another profitable Canadian specialty pharma business, then trading at $3. Now, since we recommended Cipher as a buy, the company has bought back over 6 million in stock with its cash on hand, added cash, and recently closed at around $9 per share. That is up 131%. On the flip side, Medexus, the debt-heavy company we chose not to recommend, continues to service that debt, and as a result is inhibited in its growth ambitions, closing recently at $1.60, down 47%. That is a massive 9-month swing between these 2 businesses. Warren Buffett once said, a rising tide floats all boats. Only when the tide goes out do you discover who's been swimming naked. We have witnessed over the past year and a half in the small cap arena. Solid growth stocks that have been disciplined cash accumulators are now in great advantageous positions to allocate capital. On the other hand, over-leveraged businesses can be in trouble. Now, Cypher currently ranks as a hold in our research after a strong run, but has solid long-term growth potential. We continue to favor strong balance sheets, often with net cash positions in many of the growth-oriented Canadian and U.S. small caps in our coverage. Finally, I'm going to tease one recent buy from our Canadian small cap recommendations. This buy recommendation is on a unique under-the-radar small cap that works with growth businesses such as DoorDash, Lyft, and Uber. This high-growth but low-price stock just posted earnings growth of 296% in its last quarter. The stock has already gained 20% since our recommendation, but with its growth profile, big name customer list, and strong fundamentals, this may just be the beginning. The underfollowed growth stock holds $85 million or $1.76 in cash per share with no debt. Based on our 2024 expected earnings estimate and removing the cash, the stock can be bought today at roughly 8.75 times earnings, a low multiple given the growth and strong balance sheet. This is another undervalued small cap with excellent growth that can be really found nowhere else. All right, that's going to close that out. Any comments?
It is. I mean, there are many ways that higher interest rates really do affect the growth profile of a company. So certainly if you have a lot of debt on your balance sheet, as you mentioned, if you're overly leveraged, then your costs increase. So obviously your interest rate increases, unless you're on fixed debt, but then that fixed debt eventually will roll over. You'll have to renew it, likely at a higher rate if rates are still high. But just in terms of evaluating a potential a growth investment, it changes. It essentially changes the numbers. So, for example, if I'm a company looking to do an acquisition, I want to acquire something with a expected rate of return, internal rate of return above my cost of capital. Well, if my cost of capital goes up, then I need to get a higher rate of return from this investment. But that rate of return doesn't actually automatically go up just because interest rates have gone up. In fact, in many cases, if it's more of a discretionary style business or cyclical business, that rate of return may actually go down. So I know there's many companies out there that, they're growth by acquisition businesses, and people are wondering, well, aren't assets really cheap right now, given that interest rates have gone up? And of course, the reply is yes. I mean, there's a lot of acquisition targets out there, but they're relatively more expensive from a cost of capital basis because, we either have to take on debt to pursue those acquisitions, or in some cases issue shares. But if that company's share price has also been negatively impacted by the higher rate environment, then their cost of equity capital has gone up as well. So there's a number of different ways, even if you don't have a lot of debt on your balance sheet, how you can be impacted by higher rates. But of course, if you have net cash on your balance sheet, that's capital that you can deploy without having to, really be concerned about raising debt or issuing new shares. So it puts companies in a very advantageous position.
The other factor I would add into that is when we had that super low rate period, we were seeing companies that were open to being acquired. They were asking maybe like 20 times EV/EBITDA, and now they might be at 12. But in reality, some of these companies, even if they have cash, they already have the capital funded. They might only be wanting to pay 8. It takes time for those valuations to fall over time. Mm-hmm. And across industries outside even the biopharma we've talked to, is most of them are still high, but they have come down to something more reasonable. But it's not like this fire sale level pricing, which you would want for if you do have this capital already on hand.
Yeah, we're hearing that. And then in those cases, and we continue to advise those companies that our clients own shares in, that we own shares in as well, be patient. And I think the smart management teams are doing that. The cost of capital for the company B there has gone up. They want to be acquisitive as well. That's one of the avenues they grow. That's one of the avenues both these businesses grow. But cost has gone up. Debt is already mounted. They're paying higher interest to service that debt. they get in a worse and worse position over time, whereas the other company is in a better position. Cipher's in a better position at this point, and they're sitting there and waiting out those valuations to come down to a range which makes sense for shareholders, where they can achieve that ROI, or return on invested capital, that Aaron is talking about. And it's easier to achieve that when you're paying it out of cash. And particularly, like, there's some businesses we follow that are literally paying it out of internally generated cash flow. So you're never having to raise capital, increase that share count, and you're going out there and you're able to buy those businesses from cash, and it really makes an attractive return on invested capital. Okay, we're going to move on and talk about Autodesk, a solid long-term company, good growth. Aaron's going to talk about some recent developments from the company. They had an internal investigation into the way they treated their cash flow, I believe, and they just came out with preliminary results, or preliminary outlook going forward.
Okay, excellent. So we are going to talk here about Autodesk. This is a large cap US software company, as symbol as ADSK on the NASDAQ. It trades at $209. It's a $45 billion market cap company, no yield. So what they're a global software company that provides 3D design engineering and entertainment technology solutions. So their flagship software is AutoCAD, which is widely used in the architecture, engineering, construction, and manufacturing industries. Now, when I got out of high school, the first thing that I did in college was went into mechanical engineering. AutoCAD was the software program of choice across the industry back then. And I believe that nothing has changed since then. So very strong competitive market leadership position in the 3D design space. They also have other technologies as well, including Fusion 360, Autodesk, Construction Cloud, Maya, and 3ds Max. So the company has taken a big hit to its share price just over the last couple of months here. It was in early April. The company had hit a peak of about $264, and since then we've seen the share price collapse down to about 209. A little bit lower. It had hit 200 until just recently. So we're going to get into the reasons for that. But the company did just release their preliminary Q1 financial results for fiscal 2025. These are approximations, but they're expecting that the quarter is going to report 1.42 billion in revenue, which would be year-over-year growth of 12% compared to the first quarter of last year. A GAAP diluted EPS of $1.16 compared to 75 cents last year, or an increase of 55%. And then non-GAAP EPS of 187 for an increase year over year of 20.7%. So I provided the GAAP and the non-GAAP figures here. So nearly every software company is going to report their earnings in non-GAAP. So these are adjusted earnings. The company will use its discretion to make certain adjustments to its net income figure in a way that they believe better represents the performance in that respective quarter. Now, making adjustments isn't necessarily a bad thing. Sometimes adjustments have to be made to provide a more accurate representation of earnings, but it is important to understand what those adjustments are, especially if there's a big difference between the reported GAAP and the adjusted non-GAAP figures. So in this case, being a software company, we've seen that by far the largest line item that affects the difference between GAAP earnings and non-GAAP earnings is share-based compensation. So this is a way of software companies essentially paying their employees with options to buy shares in the future. And it's widely used in the software industry, particularly. In some cases, it can be up to 20 to 40% of revenue. So it's very important to keep an eye on this figure. But going further here into the preliminary results, the company also reiterated its full year fiscal 2025 financial guidance. So for the full year, they're expecting revenue in the range of 5.99 to 6.09 billion, which would be growth of 9 to 11% compared to fiscal 2024. and non-GAAP adjusted EPS between 7.99 and 8.21, which would be growth of 5 to 8%. Now, if we look at this on a valuation basis, that would put us at a valuation of about 26 times earnings based on the midpoint of their full year financial guidance. If I look at 26 times earnings relative to software companies in general, that looks like a fairly reasonable valuation. However, we do have to note that Autodesk is a company that's had a pretty impressive track record of double-digit earnings growth, and now we're seeing that growth rate drop. So 5 to 8% earnings per share growth for the year, 9 to 11% revenue growth. So when we compare the valuation relative to the growth rate, it's, I would say, probably fair value to even possibly a little bit overvalued in the near term. What we would want to see to justify, a 25 to 35 times multiple is for that company to get back up to a growth rate in the range of, say, 12 to 20% in earnings per share annually. Now, we had highlighted the fact that the share price has taken a significant hit since early April. So why don't we talk a little bit about that? This was essentially due to an announcement on April 2nd that the company was commencing with an internal investigation regarding its accounting practices, specifically related to how it calculates its free cash flow and its non-GAAP operating margins. And this delayed the release of its annual report for fiscal 2024. Now, they just put out another release with their preliminary results on May 31st. The company announced that the internal investigation had concluded and that there would be no restatement of the financials. So essentially what they're saying here, or implying, is that all of the accounting practices were reasonable and there's no reason to make any changes. However, there were a few shuffles amongst the top management. So Deborah Clifford was removed from the position of Chief Financial Officer and reassigned to a new role of Chief Strategy Officer, while one of the board members, Elizabeth Raphael, was appointed as the interim CFO and will continue to remain on the board. So although the company is implying, I believe, with its release that there was nothing unusual found in the investigation, it seems strange to me that if the company is not making any restatements or changing their accounting practices, why they would make this management shuffle. I mean, why move your CFO into another position? Now, there could be some very logical explanations for this. The fact of the matter is we just don't know. But I will say that, there are certain top level management titles that are very specific to the roles, like obviously CEO, Chief Executive Officer, CFO, Chief Financial Officer, and COO, Chief Operating Officer. Those are very specific titles. We know what they mean. We know that they're top management, and we know exactly what those roles are supposed to do. Whereas Chief Strategy Officer, that's just kind of something that seems like it's I wouldn't want to say made up, but we don't really know what a chief strategy officer does. We know what the title implies, but going from CFO to CSO doesn't really. It indicates to me that something was unusual there. In any event, what is our take on Autodesk? We do believe it's a fantastic company in terms of the software. As I said, I used AutoCAD way back when I was in college in an engineering program. It was the leading software back then. And, many years later, I'm not going to age myself here, but a couple decades later, it is still the leading software. It's recurring revenue, subscription model business, very strong competitive advantages. The current valuation, I think, is reasonably attractive, certainly compared to software peers. But as I said, fair value to even slightly overvalued, just relative to the short-term growth rate. So we would want to see that earnings per share growth rate accelerate. And then there's the accounting policies and investigation. This may continue to be an overhang for the stock. I don't really feel, given the share price decline, that there's been an adequate response or communication from the company. But we'll essentially see how investors take this, or if there's more questions or more information that comes out on the conference call. But what I would say, just in conclusion on Autodesk, we think that it is a solid company. It continues to have strong long-term potential. We just think that it's fairly valued at the current price and has some near-term uncertainty.
Yeah. I mean, I'd agree. Autodesk is a company we continually and constantly monitor. I think it has been a great business over the long term, and their transition to a SaaS based business really, uh, you know, gave this company a great steady cash flow business, but it also ratcheted up growth for the business. Like Aaron said, it slowed. And when you're paying the multiple you're paying now, it's not exorbitant, but it's certainly not cheap. And it is maybe a company that, if there is an overall, it's one of those companies we'd watch if there's an overall market decline at some point, probably next 2, 3, 5 years, there's going to be a market correction, a significant one. If Autodesk continues to grow at their rates and even increases growth rate, it may be a company we'd add at some point at an opportune basis. It's never probably going to be extremely cheap, but it might be more effectively priced at some point, and then we might add it.
Yeah, I wouldn't be surprised if some of because we've seen over the last few, probably 3 to 7-ish years, much more like free and introductory software, as well as some free professional software, lower cost professional software in the CAD industry. So since the couple months since Aaron graduated, there's been a bit more competition. So I wouldn't be surprised if that is weighing on a bit. It's still the market leader without a doubt. But there is obviously, if someone's just thinking about going into it, they might not jump into Autodesk. I know they offer discounts or even free to university students and that sort of stuff. But when you start to get more free, more so on, more low cost alternatives, can it remain that market leader that it has for the past 20, 30 years? That's really the question which I would have right now. They do offer other products outside of their just core CAD product. They have Fusion, which I know is still to do with design and so on. And there were some other ones to do with other related softwares, but not exactly in the same area. So they have branched out, and it's not just that core CAD product, but it'll be interesting to see if they are able to keep that market position, I would say.
Yeah, I mean, I think that there's been lower price and free alternatives for a while. I think there may even have been when I was using it, but a lot of the time, especially since they're I mean, if you're just an individual using it, you're going to be more price sensitive. But if you're an enterprise that's using it, it's unless the quality of the software is equivalent, you're willing to pay a fee to get a higher quality software.
But do they get better and better is the question. Like, if they get better and better, if they use AI, can they get better and better for a cheaper cost? And then at some point, can it be disrupted? I guess anything can be at some point.
I would say part of it right now is really that sticking power, because when you are a professional, you're using the same software for years or decades, and you get so used to it that it's just worth the premium. Even if you're paying double the price, you're completing your work 10, 20% quicker just because you're used to it. So I think there's a bit of sticking power there as well, over just past if you're a new student or whatever. But that's why they do offer those free or discounted versions always. And that's the same thing which you have with Microsoft products, because they want people to get used to it when they're learning their profession and stay with it for the next 20, 30 years. And that's what I always like to watch, is can they keep that sticking power?
Yeah, I remember using AutoCAD even back in high school. I remember just briefly. I obviously went into business, so I didn't really have to afterwards. But yeah, that was 12 years ago, something like that, maybe 13. Aging myself.
You're so old.
Thanks.
All right. Okay. We can move on. You're back. No power outage, right?
Yeah,
we lost you there for a sec.
Good old Sask power. Yeah, quick power outage.
Well, I think you're up next, aren't you?
I am. Just in time.
You got CloudMD.
Yes.
A 3.5 cent stock, but we did get questions on it again. We keep getting questions on it. We've reviewed it at least twice, and thankfully have said the company doesn't meet our criteria and to avoid it.
Yeah, this is correct. So CloudMD Software and Services Inc., or DOC, on the TSX Venture, like Ryan said, trading at 3.5 cents with about a $10.7 million market cap. So CloudMD provides mental, physical, and occupational health services, health navigation, absence management and healthcare productivity tools in both Canada and the US through its integrated connected platform, KII or Key, I believe. The company has two divisions. So it's health and wellness services, which provide organizations with an employee and family assistance program, mental health care, such as therapy and coaching, medical assessments, occupational health and absence management. And as well, their other segment is health and productivity solutions. And this is such as like remote patient monitoring, for example. So, like Ryan said, I've covered CloudMD a few times on the podcast, once back in 2020 when it traded at about 60 cents per share, and again in the summer of 2021 when the stock was trading in the $1.80 range. And both times I highlighted that the company had great growth in revenue driven by acquisitions funded by share issuances and debt. But the stock was trading at expensive multiples given the hype in telemedicine, and the company was continually losing money. And as such, I said that we would stay on the sidelines. And as I mentioned, CloudMD was growing quite rapidly, acquiring many clinics and pharmacies. But in 2022 and 2023, the business began restructuring and divesting assets, selling its BC-based primary care clinics and cloud electronic medical records and practice management software to Well Health. For approximately $5.75 million. Well Health is another company that we've talked about on the podcast before. They also sold its U.S. medical records, practice management, and revenue cycle management assets for approximately $8.3 million in 2023. And as Karen Adams, the CEO of CloudMD, commented, she said, "We are divesting non-core assets and focusing on our core business to drive organic growth, improve margins, and move towards profitability next year. We will continue to reallocate capital from the sale of non-core assets back into the organic growth of the company and ensure we maximize the potential of our faster growing and higher margin EHS division." So, looking at the financials over the past 8 quarters, the divestments have driven some improvement in gross profit margins to slightly below 40%, but the company is still losing money on an adjusted EBITDA basis and earnings per share basis. So if we look at Q1 of 2024, revenue was essentially flat. Adjusted EBITDA was an ever so slight gain of about $122,000, and earnings per share was a loss of 2 cents per share. And given the company has no profitability, if we value the company on a trailing price to sales multiple, it currently trades at about 0.12 times sales. And this is a stark contrast from when I covered the stock on the podcast in 2020 and 2021, when it was trading at about 5 times and 9 times trailing sales, respectively. And there were many people out there that were trying to justify these high-flying multiples at the time. Now, if we look at the balance sheet, including restricted cash, the company has about $7.7 million in cash, with debt and leases of about $24.5 million, providing net debt of $16.8 million. And given the business doesn't even have any adjusted EBITDA, this debt is certainly a concern. And the company's share count is also something of a concern, given it now has over 300 million common shares outstanding. And as I said back in 2021, it's not that a company cannot issue shares to grow accretively, but it is a much harder process to do so. And I noted that it was a concern with the business, considering the company has no profitability and would likely continue to dilute shareholders. And as such, the company went from about 100 million shares in 2021 to about 300 million shares today. So, since July 2023, the company had been conducting a strategic review to address the company's liquidity issues, which were largely the result of the number of acquisitions completed over the last 4 years, and of course impacted the company's ability to remain a going concern, given the company's inability to generate positive cash flow to support and service the debt. And as such, on May 15th, 2024, the company announced that it would be going private through a transaction with CPS Capital, which has agreed to acquire all of the outstanding shares at 4 cents per share. And shareholders will be voting on the matter. But I think overall, we can see the failure of management to prove out the business model. And as I had concluded multiple times before, we were staying on the sidelines given the inability of management to prove out the business model as it grew revenue with no mind to the bottom line, the health of the balance sheet, or the amount of shares that it had outstanding. Now, we don't get them all right, but we certainly made the right call by saying that it was wise to avoid investing in CloudMD. Just because a company can issue shares and acquire businesses doesn't mean that it will be successful. And overall, this just enforces KeyStone's investment philosophy of how important it is to ensure that a business is able to generate cash flow before investing. Essentially, it just mitigates undue risk of possibly investing in a business, which will only dilute shareholders and destroy investor capital over time. And I'll leave you with a few negative comments we got on our previous videos covering CloudMD, such as this channel runs away from growth stocks. Nice job. And maybe you should do more research. This stock is a good find. Anyways, I'll open it up to you guys.
Yeah, pretty sure they're close to profitability, right? I've been in since 80 cents. I'm holding long and strong. In 5 years, this will be a winner. And those four takes didn't age so well.
No.
Well,
typically
I'm sure they all continue to stand by
them.
their previous statements and still somehow think that they're correct. And Brennan's wrong.
Possibly.
I would hope not. No, you need profitability, growth, and we love great growth stocks. I highlighted a couple earlier today that in this segment I had at the start, companies that we like, but we're looking for profitable growth stocks that grow their profitability, grow their cash flows over time, grow their share prices sustainably over the long term. This company was just an acquisition machine in a historic or a euphoric time in the markets, and it's ended very poorly. And,
like even some of their past acquisitions, I think they were paying like 3.5 times, sales for some of the acquisitions that they were even.
That
making.
Was probably the cheapest.
20 times. That's what I mean, and 20 times EBITDA on some of the ones that were EBITDA positive. But again, thanks Henry for commenting on YouTube, because again, this was a good comment that he said.
It's the opposite of GARP. It's growth at any price. That's what they're paying for these companies. Just growth, top line, issue a ton of shares, and then get into debt at some point. It's just a hideous way to run a business, and this is the result when it's run poorly. And even when it's run well, it's very difficult to just execute this strategy of just growing and acquiring and jamming together a bunch of disparate businesses. Anyways. All right, let's move on. Or you want to?
I want to quickly add. I keep seeing this. People say growth stocks we're allergic to or whatever. It's because I find online, especially people are saying that growth is just revenue. And it's really created this second identity to growth, where it's just pure revenue growth, ignore everything else, doesn't matter income, preferably not income in many of these people's scenarios, where that's where they define growth stocks these days. It's just revenue growth, nothing else at all. Yeah. And this is what you end up with, is just dilution into eventual. If they didn't get acquired, they probably would have been bankrupt in a couple of years.
Yeah, we like companies that consistently grow revenue and grow profitability, grow cash flow, grow earnings per share on a consistent basis over the long term. Those are the companies that, you look behind me, I got Boyd here, Hammond Power. I don't know if you see that. Those are the companies that can, if you look 10 years out, look 10 years back, they're doing that every year. There may be a hiccup in a given year because we have a pandemic or something like that, right? But over the long term, these companies consistently grow. And then you can get these long-term winners that everybody's looking at in your portfolio. Just give yourself a fighting chance by investing in companies that actually grow profitability over the long term, not just revenues, because it doesn't tell the full story. And, you get cautionary tales like CloudMD, where the stock just goes to zero. You literally lose all of your capital. We saw people investing in the stock at $1.80 plus, and they just lost everything. And that's, what we're trying to avoid. The stock market is hard enough without having a base of profitability in the businesses you invest in. And you can find the blue sky companies, the great growth stocks that we're not allergic to. Those are the companies that we like to include in our portfolios. And we're trying to teach that and talk about that on a weekly basis here. All right. Is that it? We're going to move on. Brett, our final segment. No more power outages, Brennan.
Hopefully not.
He's dropping.
All right, though. We'll move on to Reddit here. So Reddit, symbol RDDT on the New York Stock Exchange, owns and operates the website Reddit, of course, an online network of unique communities that allow users to dive into experiences built around their interests, hobbies, and passions. And their revenue model is really advertising at this time. So the company IPO'd in March of 2024 at $34 a share, but that quickly jumped after the opening. So if you never bought in before the IPO, you wouldn't have been able to get it at that $34 in reality. The shares are now at $55.30 a share, up 9% since its close on the first day, or 63% since that IPO price, resulting in a market cap of just over $9 billion. That first day jump isn't exactly uncommon for IPOs, but Reddit did better than average. I looked up a couple of numbers, and it would range anywhere between low double digits to mid-teens in that range for initial IPO day of, from their listed IPO price to the first day's close. So obviously, when you're going up 60% in it the first day, that's great. And surprisingly, they actually did beforehand open it up to more retail investors that were using their website. So some people outside of the investment banks actually benefited from that initial influx, which is nice to see. But the company recently reported its first quarter, Q1 2024, as a public company. So let's just take a look, see how they are doing. Revenue grew at 48% to $243 million. The majority of revenue, 82.2%, was derived from the US. Ad revenue increased by 39% to $222.7 million, or 91.6% of the total revenue. So as you can see, ad-driven business. When it comes to social media platforms, or really any ad-driven platform, an important non-financial metric that's commonly used is active users. You'll see this in different forms. In Reddit's case, they report daily active uniques and weekly active uniques, which increased 37% to 82.7 million and 40% to 306.2 million, respectively. Other companies, they might report similar metrics, but you always want to look at how they list the criteria. Some won't be unique users, they'll just be users, which would one-to-one that would produce a higher number if you're looking at any users versus a unique user. So you really want to look into how they are doing that. But normally you can look quarter to quarter, year over year within a company, but it's hard to compare between companies for users if you're looking at that. But the company's gross margin is 88.6%, which is expected given that ad-driven nature of revenue. That's something you will see. You'll see 70, 80, even 90% gross margin on any ad-driven company. And that should be something that you should expect. But that being said, it did jump about 5% over the past year, which is also good to see for Reddit. Adjusted EBITDA grew to a positive 10 million from a deficit of 50.2 million, the company's first positive adjusted EBITDA quarter. So previously, even when they were private, they were not adjusted EBITDA positive. GAAP income was a loss of 575 million, however. It's not uncommon for recently IPO to just have a massive GAAP net income loss, given the accounting adjustments as well as share compensation to do with an IPO. And here is just no different than that. Just taking a look at how adjusted EBITDA is calculated, we can quickly see the major difference between net income and adjusted EBITDA is a whopping $595 million in share compensation, which is just exponentially higher than the prior year's $13 million. So you can see this is when an IPO occurs, you'll have things that trigger various share vestitures, and that brings it all forward. And then, of course, the share price may raise, like in Reddit's case, which will increase also share compensation. So you really need to look at, is this just a one-off? Is this just to do with an IPO, or are they going to be a continuous share diluter over share compensation, which we do see occasionally in the software space? So looking at the IPO share compensation, what they state, what was attributable to the IPO triggering those vestitures was 535 million. So a significant amount. There was 60 million of that was directly related to the IPO. But then we can also say the share price increased, that increased the option valuation to put them in the money, and that's also included in there. At the end of the quarter, the company had a remaining 41 million in shares in RSUs and RSAs and options, 25.8 million of that being outstanding options, which are at this point, you only see the weighted average money, but they're likely all in the money given the massive increase in price. Then 15.4 million RSUs and RSAs, which have an average weighted time till vesture of 1.7 years and have a total expected expense of $280 million at this time. So over the next couple of years, you'll start to see those being recognized as they vest, which will also create a drag on their GAAP earnings from that share compensation. And that's something you really want to watch. As well, what you want to watch from here on out is, are they continuing to issue high amounts of RSUs or options? Because that can sometimes stop once a company actually goes public, or become lower at least to a more reasonable rate. Because obviously you don't want to see $500 million in share compensation every quarter when the revenue's half that. But quickly moving to the balance sheet, it's strong. Given the IPO cash injection, they already had a net cash position before this, but they added additional cash with their IPO and now has $1.67 billion in cash and marketable securities with no debt and just minor leases. So the cash is very strong. That's about 18.5% of the market cap. So the company is just, especially cash-rich, given the size of the company. Normally, once you're seeing those multiple billion-dollar companies, even a cash-rich company will only get in a single digit. So nearly 20% is quite substantial for a company the size of Reddit. Valuations, however, not attractive. Like I said, no net income, GAAP or non-GAAP even. Adjusted EBITDA was just the last quarter. So we really have to go price to sales, which isn't the greatest metric, but it's a give you an idea of where it can go if you're looking for that profitability in the future. And it's 8.2 times off roughly the forward rate, what I could find. And it's of 1.1 billion in revenue for the year. And that's not outlandish given the last quarter. And as Q4 is generally just normally the strongest quarter for an advertising-based company, 240 million times forward, than a bit more with that fourth quarter as well as growth. 1.1 billion, it seems reasonable, but 8.2 times is still quite high given that it is not a profitable company. Even just touching that profitability of possible adjusted EBITDA, it still has a ways to go to really hit that bottom line. Past advertising, the company does have an additional growth opportunity through leveraging its database of really communities and natural chatting of humans for the use of AI. After the quarter's end, the company partnered with OpenAI, which will bring in additional revenue to the company. But that being said, there is some issues with using Reddit as an AI's data set. Publicly, Google's AI search results have had blunders when using Reddit. For example, the AI result of recommending mixing Elmer glue into pizza sauce for that extra tackiness is just a great decision. And this was due to a over a decade-old Reddit post referring to that as a joke. So you're taking years and years, or even a decade-old data, which these people obviously had no idea AI was going to come into it, and now introducing it to a community that will know that future data is being used for AI and that they are susceptible to abusing that. That could be a potential risk. I'm not saying that is, but that may falter some of the database demand of Reddit, and it may not just really be that cash cow that they're hoping for if it's ultimately not good enough. But maybe some AI want to deal with that. They want to deal with looking through sarcasm, jokes, and just faulty information. So there's a potential use case, even if the data is purposely incorrect or just jokes or sarcasm and so on. But that is ultimately a growth opportunity for Reddit past advertising. But overall, Reddit is just expensive, even on sales, and has material dilution still likely to occur over the next couple of years, even if no more significant share compensation is issued, creating an overhang for the company. The company is dependent on a single, while relatively long-standing product as far as the internet go, is always a risk. If for some reason Reddit disappeared, that's actually, interestingly enough, kind of how Reddit started up. Is the previous go-to internet forum where aggregated communities was Dig. They made mistakes. Mind you, this was about 15 years ago or even more than that now. And then people migrated to Reddit. There is a direct, they were the beneficiary of it. They could ultimately blow themselves up in some manner. While I don't think that's going to happen, that is ultimately a risk when you have a single product and a really fickle community more than anything. The company is able to lean a bit on its strong balance sheet while it does trend towards profitability. But overall, given that high sales valuation in the same ballpark as big players in the ad space, such as Alphabet and Meta, it's just hard to justify given this lack of profitability at this time. So for now, I wouldn't invest in Reddit. Maybe in a few years, once the dilution is worked through, that post-IPO dilution, which you see time and time again. And if the company does end up being profitable, does still have a growth track in front of it, maybe it's worth a second look at that time. But for now,
I'd agree. Again, it's simple, just doesn't meet the profitability criteria. We're hammering on that today. Yep, it looks like a growth stock on the top line, and maybe if you adjust out some items, there's some adjusted profitability there. But our minimum criteria is good, solid cash flow, and Reddit really isn't there yet, and the valuation is just high.
Yeah, I'm glad you brought up the Reddit OpenAI like partnership, just because I mean that's hilarious. Adding Elmer Glue, I was laughing pretty hard at that. But
maybe it can train AI to deal with sarcasm. Maybe that's going to be this specialty that comes out of Reddit.
Exactly, and like that's the thing. Like, I mean, I was listening to I think his name's Edward Harris, and there was I think his brother on a podcast recently, and they were just talking about like training AI systems and how trying to basically make them understand context, where when you're testing them, you'll give them tons and tons and tons and tons of text, and just randomly out of in some random paragraph you'll put they use the example as Whopper is the best burger, and then when you ask the AI system, you're asking it what's the best burger, and hopefully it can work through basically all the text and find this randomly within the text. And again, it's just training it to like understand context, like you said, when people are making jokes on Reddit, because the amount of crap posts that are on there is ridiculous. I mean, I've been on Reddit as well. I mean, there's a lot of garbage on there.
Let's be honest, Twitter. Most human beings can't understand half the crap on Reddit, right? So we'll see.
Good luck to AI.
Yeah,
it's going to be interesting to see.
Yeah. All right. I think that ends off our show for this week. Again, keep your questions coming into our Your Stock, Our Take segment. If you're watching this right now on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcasts, rate and review us. Like I say, as always, we were looking for positive reviews. Again, as always, I'd like to wish you profitable investing. Thank you. Have a great week.
Thank you.
Thanks, everyone.
Thank you.